Welcome, everyone. Thank you so much for joining us today. It is a pleasure to welcome you to the 2022 Corporate Policy Forum. I personally am extremely excited for the conversation today about Scope 3 emissions and grateful to all of you for joining us. One quick housekeeping note, because people trickle in throughout the forum, we are going to keep the doors open. If at any point that's messing with audio, if you can't hear us, just let us know so that we can figure it out. My name is Jordan Diamond. I have the honor of serving as the president of the Environmental Law Institute, and that's why I get the privilege of welcoming you and kicking off the panel today. We know the challenges of addressing climate change. It is largely the challenge of addressing greenhouse gas emissions. In an effort to reduce greenhouse gas emissions, some companies are starting to track their Scope 3 emissions, looking at the upstream and downstream impacts of their value chain. We also have the Securities and Exchange Commission in the United States looking at their draft climate disclosure rule and proposing whether there need to be Scope 3 reporting requirements in there. The third vector in all of this is advocacy efforts to try and get companies to disclose their Scope 3 emissions. Scope 3 emissions could not be more complex. So that is why we are incredibly grateful to have this conversation today with people who are actually living and breathing this work to discuss this issue and the complexities and challenges of addressing it. It is my pleasure to open my piece of paper and introduce today's moderator, Dr. Ann Goodman. Dr. Goodman has over 30 years of international experience in sustainability, climate risk assessment, and strategic resilience planning. As an executive, an entrepreneur, communicator, consultant, researcher, and educator. She is the author of 2 books, Adapting to Change, The Business of Climate Resilience, and Collaborating for Climate Resilience. Dr. Goodman is also editor of a Taylor and Francis wide-ranging book series on our environmental renaissance. So if you'd like to propose a book, let her know. There's the little goodie for coming today. A former journalist, she has reported on sustainability and business for major media. She launched and led the Women's Network for a Sustainable Future for over a decade, expanding it throughout the U.S. and internationally. She has served on the faculty of universities in the U.S. and abroad, most recently at SUNY's Advanced Science Research Center in its Environmental Sciences Initiative. She has advised government, for and nonprofit institutions on sustainability and social impact, and has spoken on climate resilience and related topics in the Americas, Asia, and Europe. So thank you for moderating, and with no further ado, I will turn things over to you.
Well, thank you very much, Jordan, and many thanks to Madison Calhoun and ELI and all of you here today. And I would like to introduce very briefly the topic and our panelists here today, all of whom are very distinguished. This topic, as we just heard, could hardly be more timely. Scope 3 greenhouse gas emissions become more and more potent, shall we say, potent topic as the whole world is plagued by war and energy crises, by droughts, fires, storms, floods, and famine. And the attention to climate change has therefore become front and center to everything and everyone, from lawyers to policymakers worldwide, to companies large and small, and to ordinary people. So how organizations deal with greenhouse gas emissions, not just the obvious ones, the more direct ones, but the less obvious indirect ones called Scope 3 emissions, that is becoming a huge issue, not just environmentally, but also economically. So here with us today is a highly distinguished group of panelists whom I'll briefly introduce. First, to my left here is Pankaj Bhatia, who is Acting Director of Climate and Global Director of GHG Protocol at the World Resources Institute. Next to him is Steve Harper, who is Global Director of Environment and Energy Policy at Intel. Next to him is Corinne Snow, who's the counsel of Vincent and Elkins LLP. Sorry, we have not too good reading light here. And finally, we have Paul Davies, who has come all the way from London, who is an international policy expert. So I'd like to invite Pankaj to speak first, since WRI was a creator of the original protocol and continues to be importantly involved in its evolution. So, Pankaj, take it away.
Thank you. Thanks a lot. Before I commence with some introductory remarks, if I could do a quick poll here with our audience. How many of you here have heard the Scope 3 term first time today? Nobody. So, how many of you here understand the Scope 3 term in its definition? Like, what does it mean? Just 2 or 3 or 4.
It's bigger than Scope 1 and 2.
That's very good. I think, of course, we don't have a lot of time, and I want to come to the essential points very quickly. The scopes terminology was introduced first time in 2001. This was the first edition of the GHG Protocol that came out in 2001. Not many would perhaps know that the scopes framework as a concept was being used by one very famous company in the oil and gas sector. It was British Petroleum. So it was BP who had started applying this concept internally to organize their greenhouse gas inventory. And as they became part of the GHG Protocol, we picked it up from them. What does it mean? So the way the scopes framework is designed, it is meant to capture the full inventory that one could consider, like a life cycle approach. In a simpler form, I would say it's a life cycle accounting approach where we are trying to account for the full range of emissions that a company would have, both from the upstream side, from their production side, and from their downstream side. Traditionally, the approach was just to focus on production emissions. So, for example, toxic release inventory, that was one of the most well-known programs at that time. So you only focus on facility level emissions that come from your smokestack, for example. So I think the question might be, why did we come up with this kind of an approach, which I'm sure when we will hear some of my panelists, they will speak about the problems and the challenges, particularly with Scope 3. And so what was the original intention? Why did we come up with this? The original intention, I think to some extent also was a reflection, and it still continues to be a reflection of the failures of human society, of regulators, policymakers, to have good, effective policies to control greenhouse gas emissions. In the absence of such a scenario, in the absence of such a context, the reason why we came up with the idea of scopes, because we saw that with scope 1, 2, and 3, this whole framework, you are able to introduce a very strong incentive mechanism. That is what I will call. So, although I think many people might see that this is an accountability mechanism, this is a mechanism that is supposed to hold companies accountable to their scope 1, 2, and 3 impact. And that definitely is one of the objectives. But I think there is another very important objective, that we are trying to introduce a range of business incentives for companies to take action. And why are we driving them towards this type of approach? Because nobody is controlling emissions, and we are left to market forces, we are left to business plans, private sector initiatives. And in that context, it was well understood that many companies have opportunities to undertake strong climate action, not just in what one would call scope 1, that is their production emissions, but also scope 2, that is emissions from use of energy, use of electricity. That is one of the biggest source of emissions. And if we only focus on scope 1, you are missing those opportunities. And scope 3. Just take an example of oil and gas sector company. If we hold them accountable only for their production emissions, you're not asking them to control their fossil fuel production. You're not asking them to also look at what happens when fossil fuels are used. Now, they might say that is the responsibility of their customer, and we agree. And that is the beauty of, in a way, the Scope 3 framework, that it recognizes that there are multiple parties who are responsible for a given category in scope 3. So we never say it is just the oil and gas company that should actually be held accountable for product use phase emissions. It's also consumers. But we say that they must not be allowed to not be held accountable. They have to be, because they have a role to play. So this is one category, oil and gas sector products. But there are a range of products, but I think we will hear from our other colleagues here, where there are tremendous opportunities, where companies can take action, business decisions about their investments that can have a ripple effect throughout the value chain. So that is a background on why we came up with scope 3. And I think even in the present context, I think scope 3 has become now, of course, very famous and very important for a number of reasons. First of all, I think since the scope 3 standard was published in 2011, there has been a lot of progress, and if I have an opportunity, I will share some details about the progress. There are always some questions raised about scope 3 accounting is very difficult, and I completely accept that. It's not very difficult for every sector. An oil and gas sector company should not make a public claim that scope 3 accounting is very difficult. I think even a high school student can calculate their scope 3 emissions. It's just a function of how much they are selling and what is the emission factor of their products. So this is if in the world, if only oil and gas sector was doing scope 3, I think the scope 3 would have served its purpose. But it is still not doing it, and it is not difficult for them. But there are many other sectors where I think there is a very, very valid case that scope 3 is challenging. I would put in that category, for example, even IT sector. I think IT sector, the range of products and services that they offer, it requires a lot more thought and capabilities and resources to plan the scope 3 accounting well. I would say the retail sector, millions of products like Walmart sells or other retailers, so it's not going to be an easy exercise, but it is still going to be very important and worthwhile exercise. And so there are sectors where scope 3 is difficult, but then there are sectors where scope 3 is not so difficult. And I think I would really hope that policymakers in particular can see this difference. And for example, SEC was mentioned. SEC recently adopted some rules. Those are draft rules that are, I think, still going through finalization. But if SEC were to keep their original requirement, where scope 3 will be a required reporting category, I think it will be a big step forward. But they will have to identify some additional safeguards from I think financial liability perspective in the context of SEC reporting. But they may also need to be thoughtful about which sectors could be prioritized first, both in terms of their significance and also in terms of in ease of their quantification. So I'll conclude here. I think there may be some more points to share some reflections on, but I'll wait for a further opportunity.
Well, I think there are many more reflections to share, but I'd like to thank you for this very articulate overview of scope 3 emissions and the challenges they're presenting. And perhaps no party is more impacted by them than multinational companies. So next, I'd like to invite Steve Harper from Intel to talk about the company's ongoing experience with scope 3 emissions. Steve?
Thank you. We've been working on reducing our footprint, scope 1 and scope 2, for over 20 years. Excuse me, and have been tracking our progress against 80% by 2050 trend line. This was the old target pre the recent COPs. And have been ahead of that trend line for scopes 1 and 2. Scope 3 is incredibly important to us. Well, I should back up and say we recently announced new commitments to go net zero by 2040. And when people say, what's the net mean? It means we probably will have to use some offsets, but that's the last resort strategy we're going to employ. We're busy trying to figure out how we're going to get there, but that just covers scope 1 and 2. Perhaps in a feat of bad timing, we issued a scope 3 commitment to reduce our scope 3 emissions substantially by 2030. just before the SEC rule came out. And so, I'm not a lawyer, but lawyer friends of mine question whether the SEC rule is likely to survive the Supreme Court, but let's assume it does. We're going to have to report our Scope 3 emissions. Our Scope 3 emissions are 90% of our total footprint, divided between upstream and downstream. So it's material to our operations. 80% of that 90% is downstream. Now the upstream, we've got 9,000 tier 1 suppliers in 87 countries. So these are the biggest and most important suppliers to our business, 9,000. We are working with the biggest of those and the most important of those to get them into the Carbon Disclosure Project. We have a very vigorous supplier qualification process, not just for climate and environment, but for labor and conflict minerals and a variety of other things. But our biggest suppliers are getting pressure from us and their other customers to reduce their scopes 1 and 2. But it's going to be difficult. There is a large trade association called SEMI of the companies that make the machinery that we use and the chemicals we use in our processes. And our industry trade association, Semiconductor Industry Association, and SEMI have just launched an initiative to standardize how our suppliers do their accounting for their scopes 1 and 2. And we're hoping that that will improve things dramatically. Downstream is where the challenges are going to be bigger. First, I would point, there's a lot of evidence adduced by McKinsey and ACEEE, the energy efficient non-government organization, that shows that the ICT sector, the whole ecosystem, actually enables saving more energy than it is responsible for consuming. And that's through smart buildings, smart homes, the data center, which is often pointed to as a bad actor, is actually the hub of the network that produces huge net energy efficient savings. But the footprint of that sector, the data center sector, which is an important market for us, needs to be as small as possible, and it needs to be powered by renewable energy as much as possible. We're 100% renewably powered in our operations in the US, 80% worldwide. We want our customers, particularly the data center operators, to be 100% renewable as well. So that's going to be one challenge. One of the other challenges we have, just trying to figure out how much energy is consumed by the machines that contain our products. We don't sell to you. We don't sell to the customer. We're probably the only non-consumer facing company that has as big a brand presence as we do because of those irritating commercials and the Intel ding dong. But when we try to get a handle on how much energy is consumed by the machines that are powered by our CPUs, whether it's in data centers or consumer business uses of laptops and desktops, it's very difficult because we don't know where those machines are. It's our customers that sell to their customers. And so we are reliant on the Dells and Lenovo's of the world to tell us as best they know where their product is actually being sold. And then we have to figure out what's the emission factor, what's the greenhouse gas intensity of the grid, virtually every grid in the world. And so we're working out what kinds of workable averages can we use for an emissions factor to do that kind of accounting, because you just can't do it on a precise basis. Because even in the United States, we don't know on a real-time basis the greenhouse gas intensity of the grid in most places. But we're working on that. And I would say, the last thing I'll say is one of the things that's really important to us as part of Scope 3 is what a lot of people call Scope 4. Scope 4, some people say that's avoided emissions. But for example, if we sell chips to Johnson Controls or Schneider Electric, and they sell an energy efficiency solution to an industrial enterprise, which uses that solution to improve their energy efficiency and reduce their Scope 1, who gets credit for that? We're not claiming that we're going to take credit for it. That's not going to be part of our net zero calculation. Siemens or Schneider or Johnson Controls probably are not going to try to take credit for that. It's probably going to be the end customer. But we want to be able to estimate that, the handprint, we call it. And we're working with ACEEE to develop methods to measure the handprint, because we want to use that as part of the value proposition in selling our products and helping our customers sell their products. And so, there's been a lot of controversy about, whether Scope 4 is legitimate or not. I think in many industries where they're claiming there's a handprint impact, it's questionable. I think in the IT industry, it's pretty well documented, but it needs to be nailed down in terms of how big it is and what it looks like. And finally, we're trying to work with the Department of Energy and with the state energy agencies to make sure that when the money is spent for the infrastructure package and the so-called IRA, that the government is adopting digital technology strategies and not just funding insulation and double glazed windows, because there's a lot of benefits to be had through digitalization that only recently is being, I think, recognized by policymakers.
Wow, thank you very much, Steve. And I think that's an excellent introduction to challenges that even a company that has been ahead of the curve for a very long time environmentally continues to face. And of course, when we have challenges like these, we turn to lawyers. And so I would like to introduce Corinne Snow to tell us about the challenges that so many are facing and guidelines her firm offers as everyone looks ahead to what the SEC and other policymakers may require going forward. Corinne.
Thanks, Anne. Thanks for being here, everyone. So I thought I would talk broadly about the types of conversations that we're now having with clients about Scope 3, many of which have been triggered by, as everyone has been discussing, the SEC's proposed climate disclosure rules, which would require companies to disclose their Scope 3 emissions in their annual filings, if material, not clear yet what that means, or if they've been voluntarily disclosing them already. So unfortunately for companies like Intel who are trying to do a good thing here, they may have just bought themselves some brand new regulatory requirements as well. In terms of a broad framework for how to think about Scope 3 and what your particular company should be doing in this space, I think the first question to ask is why? Why are you disclosing Scope 3? Is it because you have an obligation to under some sort of regulatory requirement? Is it because you have stakeholder pressure to do so? Or is it because you think it's the right thing to do? And it could be all three. It could be any one of those three. But I think starting there helps determine how you're going to go about calculating what you think your Scope 3 are, in what way you're going to share that information. And now if you decide to share that information in your public company, there are increasing likelihoods that you will have additional regulatory requirements that go along with that. And I'll touch on that in a moment. I think the biggest piece of advice that I would give people is only commit to do what you can actually do, and check with your operational folks before you make commitments to go out and do something. And a big part of that is because these all started as aspirational commitments that people put out there, right? We want to go net zero by 2050. Those goals are quickly becoming regulatory requirements as folks like the SEC get involved, or the Federal Trade Commission, where they're looking into what they call greenwashing, claims that they say are false advertisement because you have said that you are greener, more environmentally friendly, or put out, these very explicit factual statements about what you're going to do, and they want to see that you're actually going to back them up to consumers. So I would say, sustainability used to be the realm of PR, right? And now it has become much more a place where your sustainability folks need to be talking to your legal folks, need to be talking to your operational folks to understand what is actually involved in calculating these emissions. And I would respectfully disagree that even calculating scope 1 emissions is a simple task for things like oil and gas companies, let alone their scope 3, particularly in how these scopes are starting to get defined and the accuracy that's going to be required around them for some of these regulatory requirements. And I'll give you an example of that. So for a lot of oil and gas companies, they've been having to do mandatory reporting to EPA for a number of years under Clean Air Act Subpart W. But that's only for specific facilities. And broadly, what folks are doing is doing their best estimates, sending those to EPA, and then working with the agency to sort of refine after they've sent their initial estimates. And that's because, you know, broadly what you do is you look at the types of equipment that you have, right, and the emissions that you think are likely to come out of all those, and you start making estimates. But then you have to go back on a more granular level and figure out, well, was any of that equipment offline for part of the year, right? Or did we have any shutdowns? Did we have any leaks anywhere? And that's just for covered facilities. Doing scope 1, doing all of your emissions is a much broader task. I was talking to one client where they were talking about trying to figure out the greenhouse gas emissions from the leaf blowers that they used on their properties, right? When you think about all the little uses that your company has for fuel throughout simple, mundane processes, or if you're, you know, travel for your employees, okay, how are you going to get estimates on that you think are accurate enough to report to someone like the SEC on, you know, if someone took a flight, or do you need to track now which specific hotels your employees stayed at because each hotel might have a different emissions footprint, right? Or what if somebody thought they were going to take a flight, but their flight got canceled and they got put on a different type of, you know, a different airline, or they had to take the train instead. You have to now go back and try and match all that up if you're going to accurately try and determine these emissions. And that's a real challenge. And while I think these aspirational goals to limit greenhouse gas emissions might be useful in broad terms, I would suggest that at a certain point, resources are finite, right? And if we're thinking about addressing climate change, how much time and energy are we putting into disclosure of information that may not be all that accurate, may not be something that is that's going to be readily comparable between companies, right? Because people might be using different ways of trying to come up with these same numbers. And at a certain point, what are we trying to accomplish by putting out all of these scopes? And for scope 3 in particular, I think you have real challenges. As I just said, you have all those challenges with scope 1. If you think about it, your scope 3 is everybody else's scope 1, right? And so now you have to worry about how accurate everybody else in your value chain can be about their own emissions as well. And you are potentially accountable to a regulator like the SEC for how accurate those emissions are. And can you get to that level of comfort? And if not, are you just buying your company a lot of potential litigation risk? Are you just supporting a bunch of cottage industries that are there to try and calculate numbers at the end of the day in the most accurate possible way, rather than perhaps putting those resources to better use in terms of actually addressing the larger climate issue?
Well, thank you very much, Corinne, for really going into some of the details of the challenges that companies are facing. We haven't gotten to some of the opportunities that this presents, but maybe as we go along. And finally, I would therefore like to ask Paul Davey to bring us up to date on a larger view of world policy on this issue, where things already stand and where they may be moving. Thank you.
Thank you. And thank you everyone for your time today. So I'm going to start by just agreeing with my fellow panelists that I think that the Greenhouse Gas Protocol and Scope 3 does have a significant role to play in carbon accounting going forward. But there are a number of challenges, many of which have been touched on already. But I want to start with accuracy of data. Accuracy of data globally continues to be a significant challenge. We noted earlier sort of the comments, for example, in relation to leaf blowers. But you extrapolate that and you look globally at broader value chains and the challenges that companies have in collecting data from effectively third parties and the issues they have. And that's why initiatives like PACT, the Partnership for Carbon Transparency, are incredibly important. There needs to be more certainty in terms of this data. The integrity of that data needs to be more robust, and with it, clearer accounting and more reliable data, which can then be used. But more fundamentally, I think we need to start with a question of actually, how are we using Scope 3 and the reporting of Scope 3? Scope 3, Greenhouse Gas Protocol, has an important role, a significant role to play going forward. But it's actually how that Scope 3 data is being used gives rise to a number of the challenges that I think we see. So to take one example, the Greenhouse Gas Protocol acknowledges that in terms of Scope 3 as a metric, quote unquote, it doesn't lend itself well to comparing companies with other companies. Well, that's a point really just to reflect on. And another point, look at, for example, the 15 subcategories in Scope 3. You often find companies within the same sector reporting to different subcategories. The result of that is you get very different results when you compare, for example, one company to another if you just do what I said you shouldn't do. Double counting. Double counting is another issue. But the Greenhouse Gas Protocol acknowledges that double counting is, quote unquote, an inherent part of Scope 3 accounting. But to take the points made earlier, if you're going to be held accountable for your Scope 3 emissions and there is double counting within that, then that strikes me as somewhat challenging. And then let's look sort of at what's happening internationally. So for those of you familiar with the ISSB has recently, as of Friday, acknowledged that they would be reporting on Scope 3 emissions. But in acknowledging that they're going to be reporting in Scope 3 emissions, they also acknowledge that, quote unquote, there is going to be a need to provide protections for companies in relation to that Scope 3 emissions. And further, over the weekend, the Bank Policy Institute acknowledged that it would undermine risk-based investment decisions and create an overly aggressive international baseline. So whilst we are seeing a movement towards more Scope 3 emissions internationally, for a number of the reasons given by this panel, there are significant concerns associated with the integrity of the data and how that data is being used. As I think acknowledged, the Greenhouse Gas Protocol dates back to 2001, and there are changes and refinements being made. So, for example, we are currently seeing the draft standard on land use change and carbon removals, which is a very welcome addition. And as I think we'll hear about later, there is further work being done on looking at Scope 3 and further refinements that can be made. I was very interested in the comments on, for example, avoided emissions and Scope 4, and I'd be very interested if there are going to be further clarifications around that. It's a very sort of active area amongst companies at the moment. And lastly, comments at the very beginning around sectors and the ability to control Scope 3 emissions. Looking back at the Greenhouse Gas Protocol, it talks about the ability to influence Scope 3 emissions rather than control Scope 3 emissions. And I think that's an area which is also worth further discussion. Thank you.
Well, thank you very much. Thank you all. And I think that we have some time for questions, and I'd like to start by asking the panelists if they have any questions for their fellow panelists. Anyone like to start? Corinne, you look like you might be interested in starting. Otherwise, I will ask Pankaj if you have any questions. Oh, Steve.
No, go ahead.
Go ahead.
Less a question than a comment. Before I'm an old fart, and when I was a young fart, I worked in the oil and gas industry. I worked for the old Amoco Oil, which is now BP US, and I was involved in managing their fuel regulatory program. And I think I wholeheartedly concur with your comments about it's not necessarily all that easy, even in a more straightforward sector like oil and gas compared to, say, IT. I will say, however, this is one of my favorite axes to grind. When EPA issued their initial and subsequent revision to the greenhouse gas reporting rule, the requirements for our industry and the U.S. semiconductor industry is 0.06% of total U.S. industrial greenhouse gas emissions. So, and EPA came out with a draft rule that, even by my skeptical former EPA green eye shades view of industry claims about the expense of regulations, would have cost us about $50 to $75 million in the first year, and then, you know, a smaller percent of that going forward. The oil and gas industry, in this particular case, got to take advantage of its simplicity because they were allowed to use mass balance, which, you know, doesn't take much money at all. And so here you've got a sector with huge emissions being able to do very simple calculations, and an industry with extremely small emissions having to go into great detail. So it kind of varies, the expense and difficulty varies by regulatory regime. But I think you're right that, and the double counting issue, to your point, is, I think, is going to be an important thing to parse out because it's unavoidable.
Thank you. Pankaj.
I think this partly, I think maybe I just share a reflection on this point, how easy or difficult it is. I think we agreed, we have accepted Scope 3 is going to be a challenge for most sectors. But because oil and gas sector was highlighted in particular, and I think you confirmed this is one sector, you know, even though you disagree that this might not be so accurate, but I think it's a, for an oil and gas sector company, it doesn't depend on equipment. It depends on how much fuel they consume or how much consumption of greenhouse gas generating fossil fuel products occurred in a facility. What was your inventory in the beginning? What was your inventory in the end? And you know how much was consumed. It doesn't matter which equipment were closed down, which were not working, because it's a very, very simple calculation for at least this sector. And this for the same type of emissions, that is true also for other sectors. Now, as a broader perspective on Scope 3, sometimes, you know, I give two examples. The Greenhouse Gas Protocol corporate standard was introduced first time in 2001, so it's about 21 years. And I think one expert had commented that financial accounting standards, it took them more than 100 years to be where they are. And even now, we can say that they are not perfect. There are a lot of problems. But they had a journey to reach the place of perfection, so to speak, at least that it is accepted as a good standard. financial accounting standards by US GAAP or IFRS and other standard setting bodies. We have spent only 20 years. And I really liked one comment that I think whether we like it or not, we might have to accept that the Scope 3 standard is going to be there now for years to come. I think the question for us is how are we going to deal with it in terms of the evolution that we need to make progress with respect to our specific industry sectors, specific categories. I think the point that Paul made about this new initiative, PAC, is an example of the kind of initiatives that I am seeing are happening all over the world. Some are very well known, some are not so well known. All the leading universities in the US are right now working on Scope 3 issues. How to help industry be more successful in Scope 3 reporting by using technology where possible, by having these kinds of database initiatives, and a number of other efforts. Sometimes I call, the other example sometimes I use is the example of when the first antibiotics was introduced in the world, penicillin, more than 100 years ago. We don't use penicillin anymore, but we use antibiotics because there was a purpose and value in that concept, and that works, that had worked in the past, but we continue to evolve. So this is kind of a first antibiotic we have introduced. It's supposed to help us fight some of the illness we are facing in our ecosystem with respect to climate. It's not a perfect antibiotic. It has side effects. It cannot be used by everybody, but it is a beginning of a journey. And I think it will get there, but we will all have to work together on this.
Could I?
Yes, please.
I absolutely agree. And Scope 3 is here to stay. And it has an important role, as I mentioned earlier, and I completely agree. There is an important role that we all have to identify the challenges associated with Scope 3 at the moment, some of which I identified, and to work out how best we address those going forward. It isn't perfect. I think everyone accepts that. But I think one of the key issues is that it's being used in many ways in a way which was never envisaged when Scope 3 was first developed.
Very interesting. Yeah, very important point. Corinne, do you have any questions?
Even if you accept that Scope 3 is a useful framework, even if you accept that Scope 3 is a useful framework in terms of helping individual companies figure out how they're going to limit their greenhouse gas footprint, I think a little bit of the problem with numbers is we assume a level of accuracy when we see a number that just isn't available when we're talking about scopes of emissions right now. And I think there's a little bit of a concern with getting so obsessed over the specificity and the accuracy of that number that you can lose track of what is supposed to be the larger goal here, right? Which is, can we find ways to limit greenhouse gas emissions, including through value chains and not just individual company operations?
Yeah, very important point. Numbers don't necessarily tell all the truth. So actually, several of you sort of alluded to something that I think is quite important. It seems that in Scope 3 emissions, it's more important than in throughout Scope 1, 2, and 3, but perhaps more so in Scope 3. It's very important that a number of different participants work well together, and that would be internally in the company, but also externally with others. And I would like to know how companies deal with that, what experience you have had, or what suggestions you might offer.
Well, I'll start on that one, coming from a company that is struggling with that as we speak. I mentioned earlier that we have a trade association, SIA, that covers the device makers, and we have a supplier trade association called SEMI that covers most of our chemical and what we call tool suppliers. A semiconductor manufacturing tool can vary between 25 million to $100 million a pop, and can have over 1 million parts. So these are incredibly expensive and incredibly complex articles, as EPA calls them. And oh, by the way, EPA wants our suppliers to be able to tell us everything that's in every single one of those parts. And we keep saying, wait a second, talk about spending a lot of time on money chasing a very small number and not really having an environmental impact is another example. But having said that, we face a situation with our 9,000 suppliers that we could get very different data from all of them based upon very different methodologies. And we're not going to chase down the 9,000th supplier. We're going to focus on the big ones and the ones that are most strategically important to our company. But we're working with those suppliers to make sure that we're developing a common approach. So when we get a scope 1 and 2 number or numbers from company A, supplier A, that's in the same business as supplier B, that those two numbers are apples to apples. And that's going to take time. And it's going to be difficult because in many cases, a lot of these companies are not US-based companies. They're based in Asia, and we may or may not be, a huge customer for them, but our industry is, and that's why we have to approach it. We face the same thing very successfully on conflict minerals, which you don't hear about much in the news lately. Our industry is a relatively small user of conflict minerals compared, say, to the auto industry or the jewelry industry. But the activists came after two companies, Apple and Intel, because of our brands. And we took it on as a challenge well ahead of any government requirements for reporting, which there are now, and forced the industry, our industry and our suppliers, to develop a methodology to trace basically every ounce of precious minerals and metals that we use in our products, even though there's 5 or 6 steps in the supply chain between a mine in Africa or Australia or Canada and our factory gate. That's a problem we've largely solved. And the last thing I'll say is it's really important in all of this to have some empathy for the suppliers. The last thing in the world the suppliers need is to get a different questionnaire requiring a different methodology from all 100 or 300 or 6 customers that they have. That is a recipe for disaster. And so that's why in conflict minerals, we tried to standardize it. That's what we're trying to do throughout our industry. And a good example of where it has worked, and not so much for scope 3, but for other environmental purposes, is the auto industry has developed a common database that all of the suppliers to the big auto companies use, so that the companies can get data that's developed on a consistent basis, and the suppliers aren't driven crazy with 10 different regimes.
I think Steve's point is a really important one about the impacts that this has on the supply chain and your suppliers. Particularly if you have public companies who are at a point where they're going to feel like they have to get accurate information from all of their suppliers so they can meet their own regulatory obligations, right? And there's certainly going to be winners and losers on the supplier side now, and maybe that's something that people are in favor of from a policy perspective, but bluntly, smaller companies are going to struggle with this more, right? Smaller companies are going to be less likely to be able to have the in-house resources or be able to afford to find consultants to come and measure their own scope 1 emissions with the precision and the accuracy that companies like Intel are going to be asking them for in the future.
Are you, what sort of guidelines are you suggesting to what sort of problems do you see your clients facing, and what kind of guidance are you offering in that?
I think the problem is the one that I just said, which is kind of no matter the size of your company now, you're probably going to be seeing pressure from your own customers or your regulators to start reporting these emissions and trying to figure out how you're going to accurately do so.
I think consistent methodology, critically important. Streamlining requests. We hear this time and time again from clients receiving multiple questionnaires, how frustrating that is, and what a waste of time and resources that can be. Sharing of best practice, very important. And that's why initiatives like PACT that we mentioned earlier are really important. The work that WRI and WBCSD is doing in this space, I think really will make a difference.
Yeah, please.
I wanted to express agreement, I think, in this earlier point that we're really not here for beans counting, right? We don't want to, it's supposed to be a means towards an end. So the counting is not an end. Counting is supposed to be a means towards an end, and I completely agree with that perspective. I think it is the stage where we are, where it is still the evolution of the standard, evolution of the capabilities of companies to undertake accounting, the sector by sector or commodity by commodity or category by category standardization. I think what was earlier mentioned, all these things have to come in place, and this is going to take some time. And part of this journey is also that we have an opportunity now coming up. Paul mentioned this earlier, that GHG Protocol will be beginning a process to update the Scope 3 standard and guidance. Generally speaking, we think the standard itself has been stable. We've not seen that the 15 categories framework needs to be revised in a major way, but we would like to have feedback in this process. And we also have identified some topics that we think need to be further addressed, like financed emissions, category 15, which is becoming a very important category, and how do you, for example, address the issue of cash held by companies in banks? And there is no guidance on that issue in the category. I think some guidance on what subcategorization within these categories that can actually address the issue of accuracy and significance for different sectors. And there are many other points that we expect to address in this process. And so again, this is a reflection of it's going to be a journey and improvement at every step. We are hoping SEC will also come up with robust guidelines and safeguards. They will not, for example, Scope 3 will be seen as still cannot be expected to be very accurate inventory for many sectors. I think the point that you're making, I think SEC has already, in their original draft rule, I think they have already provided some safeguards. I think, if you can correct me if I'm wrong, but I think the liability implications are not going to be there for Scope 3 reporting, as I understand.
So they've put in place some safeguards against SEC enforcement, but those don't protect you from shareholder suits. So you can still get sued by people who buy your stock for inaccurate disclosures.
So I think this would be a point we would also like to support, that it should be a function of accuracy and completeness, which varies for different sectors.
Yeah, please.
I think the CSRD really helps encapsulate this very nicely. So this is the Corporate Social Reporting Directive in Europe, which we expect to be published in the official journal in November. And in relation to CSRD, while requiring Scope 3 emissions, it says in terms of the underlying reporting standards that they shall take account of the difficulties that undertakings may encounter in gathering information from actors throughout their value chains, especially from those that are not obliged to report under CSRD. So on the one hand, it's acknowledging the role that Scope 3 has and reporting against Scope 3, but to your point, also acknowledges some of the difficulties associated with collecting and interrogating, using and reporting that data.
Yeah, please.
I think the point about we're only 20 years into the evolution and refinement of the protocol is a good one as compared to 100 plus years on the financial side. I recently watched a great movie which I commend to all of you called The Smartest Guys in the Room, which is a documentary about Enron. And it was of interest to me because I have a couple of friends who were financially ruined as a result of their employment at Enron. So it came close to home. So Enron managed to get a clean a clean audit over many years of financial manipulation and outright thievery, using the rules of the financial accounting system that's 100 years old. So my point there is that there's always going to be ways to game the system, and it's going to be important that while the system gets improved over time, that there are people who are kind of looking out for egregious claims and egregious misuse of the system. The last thing I'll say on the accounting and reporting front is Scope 4 and the concept of the handprint is really important to us and to some other industries. Not that we want to take credit in some kind of accounting sense for somebody else's Scope 1 reductions. Again, I said earlier, we'd like to use the enabling effect of our products and our customers' products as a sales pitch, as a part of the value proposition to sell the solutions. But the other reason it's important for us to figure out a way to estimate some of that and put it in our reports is we think it's important to investors. We think investors will value companies that are not just reducing their own footprint, but are actually in the market to sell solutions to other companies to reduce their footprint. And so, we're hoping that we can come up with defensible ways to do that estimation, and it's going to be an estimation so that we can report it perhaps even just in a footnote, because we think that that should be valuable information to investors who care about climate.
Are you seeing more investors request that?
Yeah, we are. It's
demanded.
It's interesting. I just read a great article in GreenBiz about the whipsaw effect on some financial management companies like BlackRock, because they're getting pressure from the progressive left to do more and not quote unquote greenwash, because they still hold stock in some fossil fuel assets. And then you got this movement by the crazy right-wingers in the governor's offices to, take money out of any investment fund that says anything positive about the, climate change and does anything about it. So I think we're seeing pressures on both sides and will for some time.
Well, I think that gets to another question, which is, are you seeing that management, in just 1 minute, that management and boards are understanding these issues more? Are they being educated on them, and so on and so forth? Either within your company or generally
certainly
speaking.
in our company, yes. Yeah. So this is the issue of the SEC rule, the issue of accounting, obviously the issue of climate change is something that gets briefed to our senior management and board on a regular basis.
Yeah. Any other comments or questions from our panelists before we turn to the audience?
A quick one on the avoided emissions, Scope 4 point that has been mentioned. I think the way scopes were designed, they have been designed for an inventory framework. So Scope 1, Scope 2, Scope 3, they all represent an inventory impact. Now, this is a technical term, but I think the point is they kind of complete the full life cycle, a series of impacts for a company. If we think about expanding scopes into another scope, I think the avoided emissions is not exactly the same concept like inventory impacts, because when you do want to quantify avoided emissions from your good products, you always compare what would have happened if your product was not introduced. So what was the alternative? And that gets into a different kind of an approach. And so that has been one hesitation, at least from the GHG Protocol standpoint, to give Scope 4 as a label for avoided emissions. I think the other one difficulty that we might face, and not particularly I think your company, but we've seen, and I really like your Enron example, that we've seen there are always some players, even with best of the rules, who will find ways to game the system. And in this particular case, what we are worried about is cherry picking, that companies would highlight and focus on good things that they're doing, but then they're, it's like tip of the iceberg in some cases, but 8 times more the bad things underneath. And how do you, in a system, enforce, in a voluntary standard particularly, that when you speak about or claim good things, that you're also held accountable for things that are not so good in your business. And so this is, I think, going to be a part of the discussion in the updates process, and we would very much welcome your feedback and guidance on how to think about this issue.
Any other final comments before we take questions?
Well, I'd say sometimes too that's based on the presumption that you even know how your products are going to be used. And to go back to the oil and gas example we were talking about earlier, a lot of these things are bought and sold on spot markets, right? You don't actually know where your product's going. It's a fungible commodity, and it doesn't all get burnt, or it doesn't all get burnt for the same purposes. Some of those go on to make petrochemicals, which include plastics, which include parts of wind turbines, right, for wind energy. And so you're speculating at the end of the day about what the actual footprint of any of your product is. And that's just a very specific example, but I think it's true for every single product out there. You don't know who your ultimate customer is going to be in most situations, or how they're going to use your product. And that makes, that means you have to make guesses in a lot of these spaces. And maybe that's okay, but that gets really hard when you have very specific regulatory requirements about the accuracy of some of these scopes.
Yes.
Just one point. In relation to avoided emissions or scope 4 emissions, if you work on the basis that the overall objective is to reduce global emissions and the global inventory, then absolutely there is a role for scope 4 avoided emissions. And in the same way as we go back to 2001 and the original architecture around greenhouse gas protocol, the views and the objectives have evolved and will continue to evolve. And I think when one talks to companies, like Steve was just outlining, there really is a very active debate going on at the moment about the importance of somehow recording avoided emissions and the role that avoided emissions will ultimately have in reducing global emissions.
Thank you. Very interesting. Well, I think we do have now the opportunity to ask our audience for questions. Yes. And if you could kindly introduce yourself first, that would be great.
If we can't hear you, we don't have to answer you.
No?
One, two. Okay.
Test. Somebody turned off the mics. So I'm Ethan Schenkman with Arnold & Porter. First, thank you for this really excellent panel. Maybe 2 years ago, our clients had no idea what Scope 3 emissions meant, many of them, and these days, it is absolutely front of mind, front of center for many, many clients who are working on voluntary GHG emission goals, net zero goals, and dealing with SEC disclosure, et cetera. So I wanted to ask about Scope 4 emissions, which you then wound up talking a lot about at the end. I'll still ask my question. Can you explain a little, a little bit more on the difference between Scope 3 and Scope 4? I think the concept of Scope 4 emissions, avoided emissions, is really important. The idea here is to incentivize the creation of new technologies which enable efficiency and greater GHG reductions, then why shouldn't this system, that we're setting up of GHG accounting fully capture that and reward it? But I'm wondering if the concept of scope 3 emissions is so broad, does it already in some sense capture what you're trying to capture with scope 4 emissions? So for example, in some sense, your scope 3 emissions are other companies' scope 1 and scope 2 emissions. So if you're enabling them upstream or downstream to lower their scope 1 and scope 2 emissions, are you already lowering your scope 3 emissions? I really like the idea. I think it's an exciting concept, but I'm trying to understand a little bit better as to why it would be necessary to define a new scope in order to fully capture the benefits of these kinds of technologies and to incentivize them.
Sure.
And I think Steve may also. I think it's a very, very good question. And I'm glad, and I'm also very surprised. Are you an engineer or a technical person?
He's a lawyer.
It's amazing. I think you immediately came to that point of the distinction. I think, when you look at the whole global system, the greenhouse gas inventory of a company, of all companies, they are a subset of that global system, in terms of scopes, scope 1, scope 2, scope 3. So there is a value chain system, and there is everything that happens outside that value chain system of a company. So you could, using scopes 1, 2, and 3, you are able to capture all the emissions that will happen in the value chain of a company. A company does not have any emissions outside the value chain. You used a word at the end which captures the point we are trying to understand and see if we need to do something about it. Benefits. A company can have benefits or losses in terms of emissions or liabilities or benefits, whatever we call, outside its value chain. It doesn't have any emissions outside its value chain. It has effects. So it can have an effect on the system. And that effect is particularly a market effect. So if Intel were to introduce a product that is very efficient, it will of course be able to capture emissions from that product in its value chain, scope 1, 2, and 3 scopes. But that product will begin to have a market effect. It will begin to displace inefficient products over a period of time. And so that's what also some companies would like to capture, because they are creating an impact by introducing a more efficient product, because they are displacing less efficient products in the market. So it is usually called market effect. And these effects are happening outside their value chain in the broader system. And so that's where I think there is a desire to be able to account for those effects, because those effects are meaningful. And we have a methodology that we provide in the GHG protocol that can be used to account for those effects. Sometimes you call them avoided emissions, sometimes you call them market benefits, but I think that is a concept.
So from our perspective, we're not advocating that they be created a new scope 4, scope 5, scope 6. I agree with you that what we talk about as the handprint should be part of scope 3. And we're not so much worried about market impacts or trying to track those. We just want to be able to take credit for direct impacts with our customers and our customers' customers, right? I think that's important. I also think there's some tension intellectually and practically in this whole realm between trying to get things as accurate as possible so that when you look at a number that comes from a company, it means something and you can count on it, whether for regulatory purposes or investment purposes. Tension between accuracy and simplicity. And I use simplicity in a simple way, not thinking that this could ever be truly simple. But if you get down to the point of having to chase every decimal point and divert resources from actual climate mitigation or other things that would be of material value to your customers, then you've gone too far. But where the sweet spot is what we're really trying to figure out as a climate community right now. So I can't wait to wake up and find out where the sweet spot is.
Any other
I'm Carol Jones with the Environmental Law Institute. So I became aware of Scope 3 working on solid waste issues, actually in my county, Montgomery County, Maryland, just north of here. And I think Scope 3 has an incredible potential for promoting prevention of waste and reuse of waste. But there's this disjuncture because in Montgomery County, we have done greenhouse gas inventory, Scope 1. Waste emissions are 2% of that. On the other hand, we know that reducing food waste in particular is extremely powerful. I mean, it's in the top 10 over all the different sectors, depending upon, time horizon, global, local, et cetera. So 2% of emissions, but it's in the top 10, reducing food waste. So I think in the case of food, there has been a lot of work to look at the full, supply chain effects. And we know that preventing is like 8 to 10 times more mitigating than composting, which is what people tend to be thinking about. The problem, of course, with the greenhouse gas inventory is the waste sector just focuses on disposal. It does not take into account the broader effects. But I guess I'm asking you, because I'm really looking at a very narrow segment of waste, to what extent you see a linkage between the producers of products and the waste sector framework to really push on this issue of preventing waste to begin with, or reusing resources in other sectors beyond the food sector.
Yeah, in our industry, we're under a lot of pressure to pay attention to circularity. And, end-of-life waste is not the front page issue. It once was, but it's still a problem. And one of our bright engineers years ago came up with a solution, which was to basically sell a shell, desktop shell or a laptop shell, where the only parts that would ever be replaced were the parts that needed to be updated. And that comes down to two things: the operating system and the CPU. And our CEO pointed out at the time, I don't think our customers, the Dells and the Lenovos of the world, will like that, because that means basically all the profits go, to Microsoft and Intel and AMD. But you're right, that's a big problem. Here is a situation where technology can be part of the solution, and the handprint can be very powerful. The reduction of food waste and the improvement of the food cold chain. And there's an interesting detail, which is that is going to require the deployment of a lot more refrigeration. And, because a lot of the spoilage is just due to lack of refrigeration, particularly in Africa and South America and parts of Asia. And obviously refrigerants, particularly the traditional ones, HFCs, have a climate impact. So that's one of the reasons why Kigali was so important to usher in new, less climate damaging refrigerants. We need to get those refrigerants and the equipment that contain them more deployed to not just in the developing world, but also here in the US, to reduce that food waste, because that's where a lot of it occurs. People focus on restaurants and grocery stores, but a lot of it is just getting the food to the grocery store, to the restaurant. You may be right. I don't know country by country.
Yeah, and as I hear your question, I'm just thinking through, if I'm Tyson's, how do I even go about trying to track and influence those sorts of issues, right? How do I figure out what the end customer is doing with half of their chicken and where it's going?
Personally, I think from a policy perspective, as opposed to a corporate perspective, we need to make progress in policies.
I think it also underscores the importance of life cycle analysis as well. So you have the whole picture, not part of the picture.
Yes.
I'm Jay Pendergrass with the Environmental Law Institute. I want to riff on something that Ethan made, and that I think a lot of you have been going around. We go back to 2001 with the protocols. We've had 20 years, more or less, of development of protocols for Scope 1, Scope 2. Your clients have known about Scope 3 for a couple of years. Everybody's talking about the developments here. Don't we have to have a similar level of development, whether it's 100 years for the Financial Accounting Standards Board, or a few decades maybe for the Government Accounting Standards Board? But, we're probably not at the stage with the development of methodologies to be putting liability on some of these things. So what is the policy route that we need to be taking to allow the development of this to have it serve a purpose? Just what do you think?
I think that it's a great question. I don't think it's a function so much of methodologies. I think it's a function of lack of data. Really, I think the Scope 3, the problem, if every company's Scope 3 was in the US, if their Scope 3 was in the US, we would have a great reporting of Scope 3, a lot more accuracy and completeness. I think the problem is a lot of these supply chains, they go into smaller countries that do not have resources, they do not have systems in place, they do not have capabilities in place. It's just not an issue in those countries. They don't even track the basic energy consumption perhaps in many of those facilities. And so, I think methodologies have been developed even in the oil and gas sector. American Petroleum Institute, if you look at their compendium, it's one of the most comprehensive methodological handbook you can find on Scope 1, Scope 2 and Scope 3 accounting in the oil and gas sector. But the problem is you don't get data, and I think that's why this initiative like PACT, it's a small initiative compared to the scale of the problem. I think the governments will have to invest resources into collecting the type of data that is required by companies to report on Scope 3. It's the long journey, I think, and countries like China will have to open up. It's, a lot of data that is contained in China is not still publicly available.
Paul, did you have something to add on that? Or?
Just on the data point, a few months ago, we had a session at ELI on the data lake, looking at ESG data and looking at the enormous amount of ESG data that was being collected. And the fact that up to now, people have used that data quite reactively. But with advances in machine learning and AI, the opportunity to be more predictive with that data. And maybe as a parting comment, whether or not there are opportunities to use machine learning and AI when we come to look at Scope 3 data to give us better clarity, better certainty. I'm sure that's an area that will be looked at, and I'm sure that's something that we would be very, very keen to explore.
Wonderful. I think we have time for one last question, if anyone has one. And if not, well, I hope we have an opportunity to discuss all of this among ourselves, and I wish to thank all of the wonderful panelists that we've had today, as well as ELI and everyone who's helped make this happen. Thank you.
Thank you so much, everybody. And thank you again to all of our panelists and our moderator. We so appreciate your attention today. We will have another event in a half an hour. Our policy forum starts, which will be recognizing the 50th anniversary of the Clean Water Act. So if you're interested in that, please stick around. But we will have coffee and I believe cookies outside for the next half an hour. So please join us back shortly. And thank you once again, everyone.